and welcome to the Eisner-Amper Engaging Alternatives podcast series. I'm your host, Elana Margulies-Snyderman, and with me today is Michael Kastner, principal at Halyard Asset Management, a New York-based manager which manages short-duration cash management strategies. Today, Michael will share his outlook for investing in short-duration cash management, including the greatest opportunities, challenges, and more. Before we dive into the conversation with Michael, don't forget to hit that like button and subscribe to Eisner-Amper wherever you listen to your podcasts. And you can also find us on YouTube at Eisner-Amper. Hi, Michael. Thank you so much for being with me today.
Hi, Elana. Thanks for having me.
Absolutely, Michael. So to kick off the conversation, tell us a little about yourself, your firm, and how you got to where you are today.
I've been trading for over 30 years, first as an options trader and then later moving into fixed income. My partner, Steve Boyd, and I have worked together for 25 years, going back to Deutsche Bank. It was there that we first established the reserve cash management strategy. We call it RCM for short. At Halyard, we specialized in fixed income asset management. We launched the firm 15 years ago in 2010, and our assets under management as of last month totaled $1.7 billion.
At Eisner-Amper, we are creative problem solvers that take a 360-degree approach focusing on you. We're an award-winning firm with decades of experience. Eisner-Amper, let's get you ready.
So, Michael, given Halyard's focus on investing in short-duration cash management strategies, I would love to hear your overall outlook for the space.
Much of what we do is dictated by the overnight interest rate that's set by the Federal Reserve. The Fed just cut that rate earlier this month, and we expect them to cut it another 50 basis points by year end.
And Michael, as a follow-up, with that outlook, how do you position your portfolios?
In building out our portfolios, we look for opportunities and securities with less than 2 years to maturity. Under normal circumstances, we're overweight investment-grade corporate bonds, and much like a stock picker, we look for companies with steady earnings and strong balance sheets.
And Michael, as a follow-up, how do you determine the valuation of a bond?
Corporate bonds offer an interest rate above a Treasury note of a similar maturity. That interest rate's called the spread. We look to find companies that have an above-average spread and hold on to them until that spread narrows, at which time we'll sell it and move on to the next opportunity.
With that being said, Michael, are all of your clients' portfolios identical?
For the most part, yes. When we trade, we allocate a position of the trade to all of the accounts. However, our offering is customizable. We have some clients that want to limit their holdings to Treasury notes only, and others want an ESG overlay.
Michael, as a follow-up, what are some of the greatest opportunities you see in your space and why?
We think the greatest opportunity is to invest our clients' cash in a way that maximizes their return, generating a better performance than they would get at a bank deposit or a money market fund.
Michael, on the other hand, what are some of the greatest challenges you face in your space and why?
Given the stage of the economy, the spread between corporate notes and Treasury notes is quite narrow. Since the Fed moved away from the zero interest rate policy a few years ago, investors have been hyper-vigilant to maximize the return on cash, and that's made corporate bonds expensive. During times of systemic stress, that spread typically widens. Sometimes, like in 2008, the spread can widen sharply and in a short period of time. To avoid that risk, we focus our investments in high-quality corporations like U.S. manufacturers and U.S. financials.
Michael, with the sectors that you just mentioned, I would like to ask, are there any that you're currently avoiding?
Yes, we avoid auto manufacturers. We don't like the cyclical nature of their business. We don't like non-U.S. banks. Most have a bail-in structure which converts debt to equity in the event of a bank failure. We don't like emerging market debt because of the history of default risk. And the same goes for asset-backed securities. In each of those sectors, we don't believe that the return is attractive enough to offset the risk assumed.
Michael, we've covered a lot of ground today and wanted to see if you have any final thoughts you would like to share with us.
Yes, I'd like to add that while we expect the Fed to cut rates at both the October and December FOMC meetings, we wouldn't be surprised if they paused further action in the first quarter.
Michael, I wanted to thank you so much for sharing your perspective with our listeners.
Thanks for having me, Elana.
And thank you for listening to the Eisner-Amper podcast series. Visit eisneramper.com for more information on this and a host of other topics. And join us for our next Eisner & Ramper podcast when we get down to business.